I do want to start off with the current situation, the collapse of 3 banks here in the U.S. and a couple others that, quite frankly, are still teetering on the edge, and a lot of questions as to why there wasn't a little bit more scrutiny, whether from regulators or from investors, as to what was going on behind the scenes.
It's interesting because in hindsight, and to be clear, we were not looking at the banks. We, as activist short sellers, generally focus on companies where there's at least some level of misleading investors, if not outright fraud. But when you look back in hindsight, these problems were there in plain sight with the disclosures about the losses on the held-to-maturity securities. So obviously what's happened is you've had the Fed hiking interest rates quite quickly, and you've had a lack of risk management by many of these banks. Now, what I think this speaks to, and this has been the bane of short sellers since the global financial crisis, is all of the leverage that has been created and all the money that's been pumped into the financial markets in order to just keep the system going and perpetuating the markets, and what they call the Fed put.
Yeah.
And so this is the cost of it. You create fragility in the system, and the crazy thing about this is that, these risks were right under the noses of the Federal Reserve Board of Governors and FOMC committee members. This wasn't something that was far afield where, in hindsight, you'd say, well, that would have been hard for them to foresee.
Right.
So that's the problem when you create these bigger and bigger powder kegs of leverage and you base your economic policy on leverage. So that's what this is a function of.